Morning, friends. Morning, YouTube. I want to take a few minutes to kind of explain to you what I was looking at last night, which is how to value a speculative or a rare asset, and how to look at an investment or not doing an investment from a risk standpoint. Now, many people think that they don't have risk in Bitcoin because they don't buy it, but in actuality, not buying something just guarantees whatever loss there is from not buying it. While buying it, puts you at risk for the loss of buying it. So you have to weigh both ways. And most people don't actually look and understand that they're making a decision to take one risk or another risk on. And so I wanted to take a few minutes and tell you about that. So first, there are three things you need to understand to value a speculative asset. Now, number one, you need to understand a price target. The second one, you need to understand the current price. And the third one you need to understand is what the probability is that the asset will get to the price target. So let's look at Bitcoin specifically and try to understand how that works out. So here is what's called a stock to flow model on Bitcoin. Now, don't worry about the name, but this line right here, the kind of bluish line here, is the projection based on this math formula that's used that it looks at the availability of an asset and compares the availability of the asset to the price and what it's selling for. And so you look at over a long period of time, starting down here at 10 cents, it predicts $1, it predicts $10. Now the thing you don't want to miss on this is that this is a log scale, which means it's tenfold. So from line to line is a 10x increase. It is not a regular line. And so when you look at the 10x increase, that changes your price target, which changes the probability that you need to make an investment. Okay. Right now, the near-term price target of Bitcoin is 100,000, right there. 100,000 all the way out to 2024, halfway through the year, when the availability of Bitcoin goes down. Okay. Price right now is 50,000. So in order to look at buying this asset, you need to know the price target. Now, a price target between 50,000 and 100,000 means that a fair valuation today is saying that that Bitcoin has a 50% probability of going to the $100,000 price target. So if you think the probability is 90% of going to 100,000 and you buy it at 50, then at the point you buy it, you made the $40,000 difference in probability. And you just have to see if your probability works out. Now, if you look at 100,000 versus 50, you're not looking at a massive decision. And so a massive decision like that isn't going to have a payout of more than 2 to 1. But if you look back at that chart right here, and you look at the 2024 probability out here, you got 1 million. Okay, this is where the graph goes. Now, going from here to here, ridiculous, right? Going from here to here, okay, I got that. But you look at these jumps that they predicted and it's made across here. It makes this jump, at least mathematically, not unrealistic. Once you understand that, you understand right now, at the current price, right here, there is a 5% probability of this price target right here. Okay? So let's say that you think the probability is 16%. Okay? Then that means that right now, based on your estimation of this probability, that means this is not worth 50,000, but it's worth 160,000. Now, the way you make money in buying speculative investments is to look at something that has a value of 50,000 or 160,000 and to buy it for 50. At the point that you buy it for 50, if you're right about the 16%, you make 110,000. You make that bet repeatedly, and that's how you make your money. Now, one more factor in here. People will say, they'll say Bitcoin is changing in value because the dollar is changing in value. So let's talk about that. So I've got right here. This is a comparison of the same stock to flow model. Okay. But it doesn't use dollars to compare. Instead it uses oil. Okay. So dollars are out of it. Government printing money is gone. The two things on this slide now are Bitcoin and the price of oil. And as you'll see, compared to the other graph, these red dots, which are the oil price, Bitcoin and oil price, meet even more closely the stock to flow model. Meaning that there's some fluctuation from the dollar, but really this is indicating changes in value of this rare commodity of Bitcoin. Now, there's one more factor that to me is a little bit overwhelming. Now, a general speculative investment, you buy for, let's say, $50,000, you sell it at some point when it hits a million or 500,000 or whatever price that probability goes out of whack with the value. Okay, that's when you would sell it. Now, Bitcoin, as I've already shown you in a previous video, you can make 6.2% interest on it while you hold it in your Celsius wallet. And so that changes the probabilities a lot, because now if you buy at 50,000 and it pays you 6.2% interest, and it goes to 100, now it's paying you 12.4% interest on your original money. And so that changes the risk a lot. And that makes it fall into what we talked about before about category 5, which is disproportionate risk rewards. Now, should you go and, YOLO all your money in Bitcoin? No. Because the other factor in it is how many years it will set you back if you lose it. So I would say if you have been accumulating wealth over a long period of time and putting it into what's true investments, then maybe looking at something that would set you back 5 or 6 months if you lost it would be an appropriate investment for Bitcoin. And so that's what I've been doing is, buying Bitcoin and some of the other assets based on those factors, the probabilities, the price, the payout of those assets, and trying to understand what investment decisions are wise. Now, people that don't buy Bitcoin are basically making the decision that buying Bitcoin is riskier than not buying it. Okay, now, based on the projections, you have a probability of losing $950,000 for every Bitcoin you don't buy. Or making $950,000. I mean, that's the projection, right? And so that's the decision. There's risk if you buy it, and there's risk if you don't buy it. Many people just want to bury their head in the sand and say, I'm not going to invest because I don't want to lose the money. But in actuality, then they've basically guaranteed their losses. And for me, if I know an asset's worth $160, it's selling for $50, if I don't buy it, I'm losing $110,000. And I don't want to lose $110,000 in whatever amounts, whatever scale, whether by 1 or half or 0.1 or whatever. I don't want to lose that amount of money. And so when you start to take some factors into account with Bitcoin, number one is that price to flow, stock to flow model is log scale. That makes your end price target 10x what it looks like on the graph, which is huge. Number two, that right now we're below that, but historically we've been on it. Number three is you give a 6.2% payout that you can get on this asset while you have it. And the last one is, where does this fit in your portfolio? What should you already have invested in? You should already have your cash going, you should already have your index funds going, and this should be a piece in there. Maybe 5 or 6 months of your investments should be focused on maybe Bitcoin. So let me know what you think about the video, and I'll talk to you all later.